Hi, everyone. This is Jason Bjork of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He has a PhD in economics, although he is more of an Austrian school economist because he writes articles for the Mises Institute as well. He is chief economist at Tressis. He is a fund manager, and he has an unbelievable amount of knowledge about markets. He even wrote a book called Escape from the Central Bank Trap. I think we're all going to need to learn more from him about escaping from the central bank trap, as it seems central bankers have totally gone out of control. Daniel LaCalle, thank you for joining me again.
Hi, thank you very much, Jason. Always a pleasure.
So, Daniel, I want to get your thoughts on this 60 Minutes interview that Jerome Powell did last weekend. Some of the stuff he talked about in there just seems crazy. So he was talking about how GDP was going to continue to fall here in the US. He was talking about the unemployment rate was going to spike. And then he said, but that's not a depression. So what are your thoughts on that?
Well, I think that, again, and this is very typical of governors of the Federal Reserve, they constantly try to give a message that is optimistic while giving messages at the same time for their listeners and for investors that seem contradictory in many senses. Think about this. If he doesn't see a depression and he doesn't see those kinds of risks, then the monetary policy that the Fed is conducting absolutely makes no sense. Then there's no need to increase the balance sheet to 6 trillion, almost 30% of the GDP of the country. So I think that this is the problem of communication of the Federal Reserve, and this constant to and fro in terms of giving on one side messages of risk falls on the downside, etc., while trying to be optimistic, is one of the reasons why there's a diminishing level of confidence about what the Federal Reserve is doing and their ability to at least have a discernible or manageable view of where the economy is going.
Now, we're recording this interview on Friday, May 22nd. We got the Fed's official balance sheet update yesterday. The balance sheet is now over $7 trillion. Since quantitative tightening ended at the end of August 2019, the balance sheet is up over $3.2 trillion. Sven Norseman Trader on Twitter was saying it's roughly an 87% increase since the end of August. It's an insane amount, but really the amount has increased mostly in the last 3 or so months. The level of central bank intervention is enormous. Is it like, I saw a figure going around, I did a video on this yesterday, it seems there's like 20 trillion in liquidity if you combine all the central bank liquidity injections in the last couple of months and then all the fiscal policy that has been done. Is that roughly the amount of liquidity that these governments and central banks have injected in only a couple of months?
Only in central banks, yes. If you put together the injections of the Bank of Japan, PBOC, the Federal Reserve, and the ECB, yeah, we're running pretty close to that figure. You're absolutely right. It is truly insane. What is truly insane is that in the case of the Federal Reserve, balance sheet of the Federal Reserve, as I said before, is about 30% of the GDP of a country. But think about this. In the Eurozone, the ECB balance sheet is at 44% of the GDP of the Euro area. In the case of Japan, it's at 110%. Is that the insanity of monetary policy is simply staggering.
Jerome Powell also in that 60 Minutes interview, he talked about how Congress needs to do more fiscal policy, but it seems that the track that Congress is on, now even the Republicans and the Federal Reserve is on, is one of MMT or MMT light, as some people are calling it. But Powell basically said that if the Fed is willing to lend it, he wants Congress to spend it. So do you see that Congress is now, both parties, including Republicans, are now committed to this MMT program where Americans can look forward to getting even more checks?
I think it is not the same. And I think that it is not the same as MMT. And we need to be extremely aware of that, because there is a risk in the political debate that the MMT defenders, particularly in the far left, will say, well, see, they're doing it, and it's a Republican government. It is not the same. It's not the same to inject liquidity via the mechanism of monetary transmission that includes the banking system and includes the federal government, than to directly monetize any spending that the government makes. It's not the same. It looks the same, but it isn't the same. Why is it not the same? First, we all see, for example, that a significant part of that liquidity is parked in bonds. It is spread out throughout different financial instruments. We might dislike it, we might not like it, but it is not the same as simply going out and printing money to finance government spending. There is still a transmission mechanism. This is very important to understand, because what MMT defenders say is the opposite. What MMT defenders say is the government comes to the Federal Reserve and says, this is how much we want to spend, this is what you need to print. The Fed doesn't do that. The Fed looks at the global demand of US dollars, looks at the how tight the level of demand for treasuries or different instruments, the global demand of US dollars, and talks about unlimited increase of money supply. But it is not unlimited. And although it seems the same, it is not the same, and it is very important that it doesn't become what I just mentioned, because that is when you go Argentina way. The idea was government decides to spend, imagine, $17 trillion into the economy, numerous packages, et cetera, and all of it is monetized, and the demand for dollars globally is falling, then you would incur in a massive economic and social problem. This, at least what they're doing, and I'm not defending it at all, so everybody that's listening, but at least what they're doing is paying a lot of attention. Few ex-colleagues of mine are in the Federal Reserve, paying a lot of attention to global demand for dollars. In the world, there is currently, as we speak, between 13 and $20 trillion shortage. And that is very important, because it leaves the possibility for the Federal Reserve to inject liquidity, because liquidity is demanded. Not to inject liquidity because government demands it, because government demands are endless. Imagine, for example, you've seen the package that was approved by the federal government, by the House and the Senate, and look at the new package that the House has just presented. Think about it. We would be now in probably between $5 to $9 trillion of additional spending, and no limit in terms of when would that be ended, etc. There is still a certain mechanism of demand and supply that remains, and that is why the dollar is relatively stable. If we move it the other way around and we go full MMT, then the United States can truly be at risk of losing the world reserve currency status. Demand for dollars would fall, and therefore the economic problem created by government spending being fully monetized would be very, very evident to the average citizen. So it's important to discern MMT style financing, monetization of government spending, than liquidity injections because there is high demand of dollars that can be used by federal government to increase a little bit or a lot its fiscal policy.
It seems that Congress, they're aware of the dollar situation, like you said, so they know that the demand for dollars for the dollar funding markets, for emerging markets that are defaulting on Chinese bonds, and also their dollar-denominated debt. Emerging markets are in a lot of pain. There's a lot of ways that emerging markets are being hurt right now. But do you think that Congress here in the US realizes the dollar situation, and they know that they can get away with more spending programs, more checks to people temporarily, but if they do too much of it, let's say if everyone gets a $2,000 per person per month check, that would be too much. So there's a fine line that they're walking, because do you think that this dollar shortage, is it temporary? 6 months from now, a year from now, is this dollar shortage going to be taken care of? Because it seems the Fed has put programs in place with the global repo facility, the currency swap lines. They're trying to fix the dollar shortage. What are your opinions if the dollar shortage, if it's only temporary?
Yeah, it is. It is temporary because there is evidently a a number of factors that have built into this dollar shortage. First, obviously, the collapse in commodities and the collapse in exports because of the lockdown of so many of the purchasing economies. Obviously, there is also a temporary factor, which is the very short-term maturities that are built in emerging economies. 2020 and 2021 are years of very high levels of US dollar denominated maturities. So I think that it is important to see that it is temporary. And second, I think that is very important as US citizens, for everyone that is thinking about the dominance of the dollar, to be over and over reminding Congress, reminding their congressman and congressperson, reminding the government that this is a very, very fragile situation, that if you push it too far, then you can easily lose that status of world reserve currency and then suffer a massive blow in the economy.
So do you think then that the problems in the dollar funding markets with the euro dollar denominated debt, that the currency swap lines and the global repo facility, they're going to calm things down? Or do you think that the Fed, this is not going to solve the problem?
Well, they will calm things down because obviously it is addressing that problem. However, it all depends on how governments and central banks all over the world react to that. There are two ways in which you react to that: to put structural reforms in place so that the twin deficits of so many emerging economies are reduced, therefore the fiscal deficit is reduced and the trade deficit is reduced. That reduces the global dollar shortage. And if central banks in other countries don't continue to implement very aggressive expansionary monetary policies. One of the reasons why there's this massive dollar shortage is because domestic and international investors don't want local currency risk in emerging markets, and therefore because they know that at some point the central bank is going to destroy the purchasing power of the currency, so they don't want that. If there is confidence that central banks in emerging markets are going to behave prudently, then that dollar shortage can redirect itself to something a little bit more manageable. Do I think it will happen? No. I think that unfortunately emerging economies and China will take the opportunity of the Fed injecting more dollars into the economy, of increasing their imbalances in foreign currency, taking more debt, increasing the trade deficit, increasing the fiscal deficit. In the case of China, it doesn't have a trade deficit with the US, as everybody knows, but it has a trade deficit with the rest of the world. So with almost all of the other countries with which it trades. So that is something that generates also significant FX imbalances. But again, what I think that the Federal Reserve is going to do is mitigate at least the possibility of a crash. And I think that that is what it is doing right now.
I want to transition now to the Chinese economy since you brought it up. We've discussed them at length in past interviews. So it seems that China is adding over $400 billion per month in credit now, but the global economy is not functioning properly. So a lot of exporters are not earning their dollars through commodities or luxury goods exporting to China. There's a lot of dollar denominated debt. We have emerging markets that are defaulting on Chinese bonds. And what's your opinion of the Chinese economy right now? Because it seems that a lot of their manufacturers, there is no demand to export. I've seen estimates out there that demand for exports orders for a lot of Chinese manufacturers are down up to 70%. So if that continues, is China going to have to step in and do unprecedented levels of quantitative easing? Or do you think that the inflation levels, I've heard anecdotally from a lot of contacts in China that there's really bad stagflation there. Do you think that the people in power are aware of this and that's why they haven't done insane levels of QE yet?
Yeah, they are aware of that. As you know, food prices in China have rocketed, and inflation, not the official CPI, obviously, but the analysis and the calculation of inflation that independent houses make, are talking about an inflation that is closer to 7.5%, 8%, even some people say 10%, compared to a growth that is going to be probably 2% at best, even considering the massive intervention from government spending. So that, as you were mentioning, is stagflation. The government is aware of that, and that's why the government has not conducted what everybody knows that they have to do, which is a massive devaluation of the yuan. And the reason why it has not implemented an aggressive QE, it is injecting an incredible amount of liquidity and trying to generate an increase in money supply growth via the banking sector. But at some point, the government is going to have to do either a form of devaluation or some very aggressive structural reform. The latter is virtually impossible in this situation. So the economy, Chinese economy right now, is like a factory that is building things that are not being sold. So working capital build is a big problem. The official figures of growth are not that bad because a lot of the activity is coming back to build things that are not being sold or exported. That has a very big risk of creating short-term a big deflationary spiral globally once they start to try to export that almost at any price. And it will exacerbate the issue of their US dollar shortage that we mentioned before. It is true that China has about $3 trillion of FX reserves, but that, as you very well know, covers about 60% of its dollar-denominated liabilities, plus, and this is the critical part, plus the expected US foreign exchange liabilities in the next 2 to 3 years.
And the Wall Street Journal last month reported that Chinese banks were running out of dollars, and that's because global trade is not functioning. I've called this the cash flow problem. So when global trade is functioning normally, countries, foreign companies, they can earn their dollars through trade, exporting commodities, selling to American companies, tourists visiting other countries, but that's not happening right now. So you have all this debt in the world, there's too much debt, and there's no cash flow or very little cash flow to actually service it.
Very true. And there's another problem in China is that the utilization of the yuan is very, very poor. As you know, the yuan is used in about 4% of global transactions, according to the Bank of International Settlements, relative to, for example, the US dollar, which is the vast majority, or the euro. So compared to the size of the Chinese economy globally, which is about 17%, 4% utilization shows that it's a very, very, let's say, irrelevant currency in terms of global trade. I think that also an important factor is that China in the past 3 years has been massively increasing its capital controls. This was a very, very tight capital control system. That generates very little confidence in order to accept trading in anything else than dollars or euros. So China would have to do something that is very, very difficult because you cannot sort of bake the cake and eat it at the same time. On one side, it would have to open its capital markets in order to allow the yuan to be a more accepted currency. And on the other side, it would have to allow the flow of capital between foreign companies and Chinese companies to be done transparently. That runs the risk of generating a massive outflow of capital from China at the beginning, because obviously the yuan would devalue or depreciate in the market very, very quickly. So it's a very, very difficult puzzle that the Chinese government tries to put together, because it wants to be a global player in the financial markets and at the same time keep capital controls. That is impossible. It wants to be it wants to reduce its dependence on foreign exchange denominated debt, while at the same time, the confidence in the utilization of the yuan remains very poor. So it needs, the government needs to take a much more proactive policy of opening the economy, and that doesn't seem to be where they're at in terms of objectives, particularly with what we're hearing these days.
And I think the Chinese economy for the last couple decades since they joined the World Trade Organization has benefited immensely from globalization. But Daniel, it seems that the trend now, US-China relations with other countries, trading wise with China, based on what's happened just in the last like 3 or 4 months with the coronavirus global pandemic, it seems that trade relations with the US and China, they were bad before the coronavirus. They're only getting worse. Other countries now, the sentiment from politicians in other countries in Europe, the amount of people who are claiming, at least online, they're claiming that they're going to boycott Chinese goods. So do you think the Chinese economy would be really, really hurt if deglobalization actually accelerates in the next 10 years and if US and China trade relations continue to worsen?
I mean, obviously, as an economy that depends so much on exporting to other nations, it is extremely damaging for the Chinese economy to see a rise in protectionism from other economies, and definitely to see some level of aggressiveness towards the behavior of China itself as a nation. I think that it would be damaging for everybody, but obviously, if what we're reading, for example, in Japan, is that the government is going to give subsidies to Japanese companies to bring their production from China to Japan, if what we're hearing from the French is that they're telling their companies to bring back some production out of China and into France, if that is sort of scattered news here and there, scattered headlines, becomes a global trend, it can be devastating for the Chinese economy. It could be atrocious. It would not be, let me start from something, okay? I'm not advocating it at all. It would be abominable for many of those economies that would do it, particularly for Japan. However, I don't see what China could do to keep its population at work, fed, and a very indebted system alive if it does not continue to generate the enormous trade surplus that it generates fundamentally with the United States.
Wouldn't China attempt to go the Soviet Union route, where more and more of their factories then are subsidized bailouts, and then it's full central planning with the factories? Because this is where the Soviet Union got in trouble. A lot of people thought that the Soviet Union, with their central planning economy, would be able to manufacture really, really well, but they produced manufacturing that no one wanted. So there was a lot of supply that was not demanded by the consumer.
Yeah, no, I always say that that communist Germany and the Soviet Union were actually in history examples of death by working capital. You build things that people don't want, and you continue to build them and generate constant losses. And if you extrapolate that to more and more parts of the economy, you end up bankrupt. That's what happened with communist Germany and what happened with the Soviet Union, that they literally, there was no profit side of the economy that could offset the subsidized and the working capital building side of the economy. In the case of China, I think that they're smarter, to be fairly honest. I think that the Chinese are smart enough to remember their own history. No, they might sweeten it, and they might, in terms of public perception, they might not say anything negative about it. But I think that everybody in the Chinese Communist Party know that the Chinese economy has gone through hunger, through absolute devastation and poverty and disastrous situations when they decided to go that way. Therefore, I think that the Chinese economy, if anything, the Chinese government, if anything, is going to go further and deeper into the mercantilist mode, sort of similar to Russia. You see what I mean? In which you have a profit-based economy, but it's massively directed by the government, but it's a profit-based economy. There are companies that are, that are going to continuously be bailed out, etc. But they are at the same time going to make sure that the ones that do well do much better. You see what I mean? I think that they're smart enough in that sense of learning about their history, because their history is not the same of the Soviet Union or Communist Germany. Communist Germany was bailed out by the Federal Republic and continues to be so, to be fairly honest. In the case of the Soviet Union, what you had is that when the communist regime collapsed, you had at least some level of support from the rising commodity prices and the rising commodity trade. None of those are things that China can count. So I think that they are likely to go further into the mercantilist route that they have been implemented, to be fairly honest.
The largest wastes I see so far in China are from the state-owned enterprises that are basically not-for-profit and subsidized with steel production and aluminum.
Yeah.
So they're just, I've seen data coming out recently from my friend Jeffrey Landsberg at Commodore Research. He tracks these things on a daily basis, Monday through Friday. The amount of steel production out of China is spiking a lot. So I don't know how much demand there is for steel right now in China, but they've just decided at the steel mills to produce a lot of it and just stockpile it.
Yeah, that's a very typical way of boosting GDP. There's a reason why so many countries that have unprofitable steel mills maintain them, is because it's very GDP artificially enhancing, if that makes any sense. So the risk is what you've just said, is that you decide to turn on the factories and turn on the steel mills and start producing things that you just stockpile and wait for demand to come, and maybe that demand doesn't come because there was already overcapacity. This is an important factor in 2019. And secondly, it creates a financial problem. There's another thing that people are starting to be concerned about in some economies, which is that governments, in order to try to bring GDP up a little bit, they go to their state-owned enterprises and just keep them functioning, but they're not producing anything. So, the lights are on, the workers are moving from place to place, but they're not doing anything. That is actually almost as dangerous.
Misallocation of capital, as Austrian school economists would say.
Oh, huge. And that is going to happen in so many economies. That is going to happen in so many economies that you're going to, any government that has some level of control over an enterprise, because it's state-owned, will say, hey guys, get people there and start, painting walls if needed. I mean, remember Japan in the 90s, no? That's something that actually happened.
So you wrote the book, Escape from the Central Bank Trap. It seems that Japan is the model that a lot of these different countries like the US, the European Union, and others want to copy. But can every major central bank in these economic zones or countries, can they copy what Japan has done for decades?
No, it's very difficult. For that to happen, you would need the reason why the Japanese disaster has been prolonged for so many decades. It has cultural and economic reasons. The cultural ones are very simple. The government in Japan says, everybody, let's go to work, even if work is painting walls or doing nothing at all, just looking down at the screen and going back home at 5 o'clock. They do it. The government says we need to lower salaries. Salaries are lowered. No one complains. So cultural part, important. And the government, obviously, in pension funds is injecting the vast majority of the bonds that Japan issues, and therefore the Japanese themselves are suffering the burden of something that is unprofitable and doesn't generate any return, but keeps sort of the Ponzi scheme, if you want to call it that way, going. Economically, Japan works because it's a massive saver of US dollars. You have a huge network of industrial conglomerates that have factories all over the world that generate a massive surplus of foreign currency that is imported into Japan. That makes the foreign exchange reserves of the Bank of Japan sufficiently strong to keep the very delicate balance of this massive level of debt and huge monetary insanity together. That cannot happen in many other places. You cannot tell bond holders in the United States that they need to own negative yielding bonds in the United States. No, same with so many others. So I think that you have to be extremely cautious about believing that the Japanese model can be replicated in economies that have completely different cultural and saving patterns. Americans are not savers like the Japanese. Japanese people, it doesn't matter if interest rates are low, etc. They save. They save money like there's no tomorrow. They spend a little bit on a holiday every 3 years, and that's it. That's not the case in the United States. That is not the case in Europe either. Therefore, the only way in which the US can increase its monetary imbalances, or keep them at least, is if it continues to be the global reserve currency. If it goes crazy MMT style, it would lose the global reserve currency status and be out of, in an out and out depression, no question about it. The European Union is a different thing. The euro is only used in almost virtually only used within Eurozone countries. So it's all dependent on their own faith in each other. Very, very difficult and fragile environment right now. But so there are important, let's say, differences, and it's very dangerous. And I say this to my friends at the ECB when I speak with them. It is extremely dangerous that they go out and try to implement the yield management policies of the Bank of Japan, and try to implement the policies of the Bank of Japan because they don't count with the same levels of savings and resources. European companies are not savers. European companies are actually companies that generate a very significant amount of working capital in order to keep their level of growth.
And Japan was also the only country doing this, Daniel, for decades. So
Absolutely.
That's how they were able to export a lot of their monetary inflation. The yen carry trade caused a lot of asset bubbles in a lot of different markets with the crazy stuff that SoftBank was doing. Masa-san was doing a debt for equity swap. He was issuing bonds, Japanese debt, to Japanese investors, and then going and taking that capital and speculating all over the globe, in China, the US, and Silicon Valley, on very speculative Silicon Valley unicorns. So that's not a sustainable business model, to borrow massive amounts of debt, even at ultra cheap interest rates, and then go and speculate on tech companies that may never make a profit.
I completely agree with that.
So I want to get your thoughts on negative interest rate policy. More of these central bankers are talking about that. That's part of, I guess, financial repression and yield control. Is this part of Keynesian economics? Because Keynes didn't want people to save. He believed in the paradox of thrift. Is this like taking Keynesian economics to the extreme then, to try to force people to not save, even though people might want to save now because there's very uncertain times? So negative interest rate policy is there to not only strip people of interest income for retirees and pension funds, but also to try to force people to spend, because according to Keynes, consumer spending is what drives the economy.
Yeah, to a certain extent, it is taking Keynesian thoughts and blowing them out of proportion. Because if you remember, Keynes also mentioned that in times of boom, governments have to save and lower taxes so that the consumer builds savings in order to continue to increase consumption and be comfortable with a certain level of spending throughout time. What we're seeing right now is closer to pure financial repression, which is not just trying to get savers to consume or to take more risk, but directly transferring wealth from real salaries and savers to the indebted. I think that is there's an important difference considered with what you were mentioning before. I think that central banks and governments are pretty aware that the savings ratio of families and that the savings ratio in general of the economy is not high, and that the level of household debt and that the level of corporate debt does not suggest in any shape or form that there is an excess of savings. The concept of excessive savings that some Keynesians or neo-Keynesians used, in which they deduct the existing debt, makes absolutely no sense to anyone. No?
Well, they're saying there's claims out there saying that there's a global savings glut. I don't see it because of how leveraged everything is. I think there's a debt problem.
Yeah, because you're absolutely right. There's not. In order to believe that there's a savings glut, you have to consider that the existing debt, that what is already issued, doesn't matter, and that whoever is earning a salary or getting an income does not need to worry about repaying that debt. This is ridiculous. It is completely ridiculous.
Also, at basic university level economics classes for a global macro class, like an entry level one, they'll say savings equals investment, but that's not how things work in reality, especially with the system we have now where everything's so leveraged.
Absolutely. The savings equal investing is in an environment in which things are not levered twice, 3 times equity. But think about it. To say that there is an excess of savings when debt to GDP globally is above 300% and private debt is above 100, household debt is also close to 100%. I mean, it doesn't make any sense.
Yeah, I completely agree. There's a debt problem, and now we have a cash flow problem, which with a lack of cash flow, you can't service the debt.
Exactly. We have a solvency problem, that we are drowning in liquidity. It's ridiculous. It's not. It has absolutely nothing to do with credit demand or with a need for liquidity. So central banks are injecting money in the economy, expecting people to take more credit when there's not a question of credit, it's a question of solvency. Is that you don't have sales, as you just said. It's a problem of cash flow.
So I want to get your opinion on gold. Is there any scenario you see with all this central banker craziness, politicians changing rules, where gold doesn't do well?
I only see one scenario in which gold doesn't do well, which is if there was a V-shaped recovery and it was a V-shaped recovery with higher productivity and higher real wages for the average worker globally. I don't see it happening at all, at all.
So you're a fund manager. I'm sure you have conversations with other fund managers, whether they specialize in commodities or emerging markets, or they're generalist money managers with a lot of assets under management. Do you hear from conversations with them that generalist money managers who in the past didn't own any gold or gold stocks, maybe even hated gold or gold stocks, they are reluctantly, over the last month to 6 weeks, they are now starting to accumulate. Maybe they're not allowed to buy physical gold with their assets under management or even the GLD, but they're starting to accumulate now some of these gold stocks so they have a proxy to a higher gold price.
Most fund managers massively levered to the dollar carry trade. As such, owning gold hurts them. You see what I mean? Because if what you want in every part of your portfolio is the dollar to weaken, emerging markets to go up, cyclical stocks to go up, high risk bonds to go up, and the economy to be inflated away of its debt, then owning gold is almost like going against your religion. However, what I find extremely interesting is that more and more people, as you just said, that hated gold. I remember having discussions with people that said to me, Daniel, that's stupid. Gold is worth nothing. You cannot eat it. If you have a share of Telecom Italia or of Exxon, it is worth 10 times more than a bullion of gold. Obviously, they're starting to understand that is not the case. So it's what I find interesting is that faith in the eternal weakness of the US dollar and faith in the eternal weakness of gold relative to assets is fading and fading fast. And but the majority of fund managers that I know hate gold with a passion. And I can understand why. If you love bank stocks, you have to hate gold, no?
It would seem what you were saying there with the dollar carry trade, that gold would be a good hedge, at least for part of the portfolio, because it would be non-correlated though.
Yeah, but people in the past, I remember when I was at Citadel that people that we spent every single hour, every single day trying to decorrelate, trying to have low volatility and trying to reduce risk of external factors. That mentality has disappeared from most fund managers, including the hedge fund world. No, people are geared to the cycle. People don't want decorrelation. They are buying correlation. In fact, you buy high yield bonds in emerging economies, and at the same time you buy commodities, and at the same time you buy cyclical stocks in Europe. So in reality, you're taking the same bet. So the times that I remember in which every day painfully we would try to bring down country risk, commodity risk, interest rate risk, all those things in a portfolio and bring it to zero and zero beta, zero market neutral. That is gone. I don't see people that are market neutral and that look for decorrelated returns. Furthermore, if you're in a portfolio predominantly long only, you have 80% of your assets are skewed to the cycle. Why would you want to own 20% that is decorrelated? In reality, it does nothing to you.
Well, according to Christopher Cole, that people should have more hedges with volatility and with gold. So over the long term,
I agree with that. No, listen, I completely agree with the strategy, and I've been promoting it all day in and day out to our fund managers. But I see how fund managers detest gold.
Is it because of their views that they were taught with Warren Buffett that it's not productive at all, and because of the Keynesian economics that they learned at the university, where like gold caused the Great Depression in 1929?
Yeah, and the faith, almost religious faith in central banks. Is that, if Ms. Lagarde, if Mr. Powell, if Mr. Bernanke says so, it has to be true. Oh, absolutely, absolutely, I see it. But I completely agree with what you were saying. I completely agree with so many people who are saying, look, it doesn't make sense to have a strategy that is only skewed to one part of the cycle. You need to have a certain level of decorrelation so that even if you dislike gold, so that when things go wrong, you actually have the possibility of buying the things that you like and that have collapsed. I find it as completely logical. When I was at Citadel, we used to talk of having a portfolio that looked like a football team in a field. You need to have goalkeepers. You cannot have just those that, you cannot just have, coming back to talking about American football for our audience, you cannot have just quarterbacks. You need to have linebackers, no? And you need to have linebackers in a portfolio, and gold is obviously the best one in bull and in bear markets. Remember how we have seen in the last 3 years how gold was rising with the dollar.
Unfortunately, Daniel, I think we have a lot of over-leveraged and unhedged hedge fund managers. And from what I've heard from different sources, a lot of them that were using the risk parity trade, the basis trade in February and March, they got bailed out. So
Yeah.
it's just ridiculous that they should have hedged. They should have had some gold exposure. They should have had cash. They didn't have any of those things. They did what you said, where they just made enormous leverage bets on the cycle, hoping to get rich quick, and then their trades blew up.
Yeah, but again, let's go back to who's to blame. It's central banks and policy that is telling you day in and day out, and that you shouldn't be hedged, that you should take aggressive bets, that everything you see, that is what it's telling you by lowering interest rates and massively increasing liquidity. But also, it's clients, it's investors. You know, when I was, again, I come back to my hedge fund days, when market neutral hedge fund days, clients demanded that you would be beta neutral, market neutral, and decorrelated, low volatility. Unfortunately, with the massive increase of exposure to passive funds, the idea that markets can only go up, that it's an eternal bull market, and things like that. It's been clients themselves who have gone to hedge funds that I know and that have been competitors and that are good friends of mine that used to be market neutral and told them to be 80% net long. Those things have happened in the past 10 years, a little bit more than 10 years, actually.
So it's all about short-term returns, and it's every day, each week, each month, each quarter then, and that's all that matters. So people are trying to extract every last penny of upside, but not protecting themselves on the downside with hedges, with defense, with...
Yeah, absolutely.
I see that a lot, unfortunately, because I think gold having cash in case there's another stock market crash. Cash is good for optionality in case there is another stock market crash or the oil market crashes and some good oil stocks go on sale. And gold, those are all good, solid defensive plays, but a lot of professional money managers don't have those.
No, I completely agree. In general, there is a... Think about this. If you go, I've seen this with, I know fund managers that are extremely well positioned and that are up 10, 20% this one. And they're not getting any capital in because investors say, oh yeah, you know, they actually don't mind that the funds that they're invested are down 13, 14, 15, 20% if next year they're up 30. See what I mean? Where everybody's levered to the same game. That's why all of us that sort of divert from the mainstream message fail to get the level of let's say attention that sometimes should be had. No.
Couple more questions here before I let you go for the interview. Thank you so much for your time. I want to get your opinion on the oil market. So we had negative oil prices not too long ago. Oil prices are now rallying. They're at 2-month highs. Do you think the bottom in the oil market is in, or do you think if the real economy the recovery of the real economy starts to stall, that the oil price will start to collapse again?
If we have a second wave of coronavirus, or if the lockdown, once the lockdown is ended and we have 2 months of data of so-called recovery, and we see that consumption, travel, and trade are not coming back as expected and it's more L-shaped, oil prices will dip further. But I think that getting to, you know, if oil prices get to $10, $15, they overshoot and then they come back to sort of a more rational level of price. We're closer to what I would consider a price that is normal in an environment of overcapacity like the one that we have.
Yeah, I think the main problem is still demand. So supply was not being cut fast enough because demand had totally collapsed. We are seeing some Chinese oil demand come back. I don't know how much of it is stockpiling and how much of it is actual economic use. The traffic data I've seen out of China has not spiked massively yet. But I have not seen big increases in oil usage in the US or European Union yet.
Yeah, and let's remember that in any case, any analysis of supply and demand that we make is not taking into account that there's already 2.8 million barrels a day of excess capacity that has been taken out of the market by producers, no?
Yeah, that's true. There's also a ton of oil in those oil tankers. So that trade worked for a while. I'm not sure how much longer that worked. The lease rates for some of these oil tankers, I think it's dropped over 20% in just the last couple of weeks.
Yeah.
So as we wrap things up here, final thoughts on the European Union. Do you think the strains from what the European Central Bank is doing, how bad the economies are doing in the Eurozone, do you think this means that the European Union, it's not going to stay together in the coming years? Or do you think that the European Central Bank and the other politicians, the technocrats in Brussels, will figure out a way to keep it together?
I think that the European Union is very difficult to break. It's very difficult to break because I always say to my students that the Beatles didn't break up because of Ringo. The Beatles broke up because Paul McCartney said, "I'm not paying anymore." And I know that it's a funny or ironic comment, but the European Union would not break up because of Italy or because of Spain. None of those countries are going to leave. They have too much at stake of being within the European Union. It would only break up if Germany said, "This is enough." I don't think that that is the case because the European Union works sort of like a vendor financing scheme.
The other point, that's a good point with the vendor financing, but doesn't Germany also benefits from a weak euro, right? Their manufacturers do.
Of course, Germany benefits from the weak euro and the demand from the southern economies. And the southern economies benefit from the massive amount of debt that in no way they could have, and the level of deficits and the level of government spending that they could have if they were independent. Think about it. If Spain or Italy left the European Union, first, obviously, economic collapse. Second, the government's spending that they have today with about 40% of GDP would have to be halved to be barely manageable. It's impossible. Pensions, social security, all those things. So the point is, I don't think that the European Union will break, but I think that unfortunately the European Union is going down a path that is very unrealistic, which is to try to set an example for the rest of the world of stagnation that everybody has to follow with these green and these no, not because I have anything against green policies, so I have everything against directed green policies from governments that have no idea about technology or about disruptive technology.
Yeah, I totally agree. Look how much money, capital, Germany wasted trying to subsidize solar, and German manufacturers became uncompetitive. Their electricity costs were too high. Solar in Germany, with the government subsidizing it, it just didn't work.
Yeah. Absolutely. And if it didn't work in Germany, that tends to plan things reasonably, imagine in the rest of Europe.
With some areas, there's more sun there, but government doing central planning, it's not going to work. If there was a free market entrepreneurs that figured out lower cost solar projects, then maybe. But the problem is the waste, fraud, corruption, and abuse from governments doing central banks doing central planning.
Absolutely.
China's making enormous investments with the Belt and Road Initiative. They're making a lot of investments into the European Union, whether that's the Italy, which is the first G7 country they've done. So it seems that China is pretty invested in the United Kingdom and Europe too now.
Yeah, they are. Absolutely, they are. And therefore, that creates a level of codependency that makes it very difficult to break up the collateral that supports all of those investments, which is the euro. Mm-hmm.
But I think the people in Europe, that what I'm seeing online, a lot of people now are really starting to get angry with the Chinese government over how the coronavirus was handled. But the politicians, Daniel, like you said, the central planners, the politicians, they seem interested in maintaining the relationship with the Chinese government. But the people on the ground, they seem to not want this anymore.
It's there is a certain level, yeah, absolutely, of discontent about the lack of transparency. Certainly, I would not disagree with that at all.
So I want to thank you so much for your time today. You've given my listeners a ton to think about, incredible insights there about the dollar shortage, the global economy, the European Union, and of course the gold market with how professional money managers and hedge fund managers think. If my listeners want to follow more of your work, you do put out an excellent Twitter, and please talk about your articles that you write on Mises and your books.
Thank you so much. Yes, you can follow me on Twitter. Handle, it's at DLACALLE_IA. My website, www.dlacalle.com. And my new book is called Freedom or Equality. It touches upon all the things that we have talked about today. Let's continue the dialogue.
And hopefully we can escape from the central bank trap.
Let's hope so. Thank you so much, Jason. Stay safe, and thank you very much.